Welcome to this explainer. I'm stepping into the role of your professional financial advisor today, and we're sitting down for a complete masterclass to map out your personalized, step-by-step blueprint from financial crisis all the way to generational wealth. Grab a notepad, because this isn't just theory. It's a highly practical implementation tutorial, and we're going to build your financial fortress right from the ground up.
Okay, let's map out this financial plan. We're going to cover stabilizing your financial base, building your core portfolio, targeting income and growth, protecting your capital, and finally, scaling your own asset.
Section 1. Stabilize your financial base. We are escaping the crisis zone.
Look, before we invest a single dime into the market, we've got to extinguish the fire and get you completely out of survival mode. You simply can't build long-term wealth when the math of your everyday life just doesn't work. The absolute crucial point here is that a specific $500 buffer is exactly what separates a flat tire being just an annoying bad Tuesday from a flat tire triggering an eviction 2 months later. When you have zero cushion, a single minor emergency starts this terrifying domino effect. So this $500, that's your initial shock absorber.
To quickly build that armor, I advise my clients to take 3 immediate triage actions to stop the financial bleeding today. First, call your creditors for hardship programs. Honestly, a single phone call can pause your payments and grant you some much-needed breathing room. Second, if you're in the U.S., dial 211 for local rental and food assistance. And third, aggressively sell non-essential items. Those old electronics or designer bags sitting in your closet, those are now your ticket to survival.
And this perfectly illustrates the ascent up the wealth ladder. It's actually achieved by simply automating a $50 a week transfer to a separate bank account and cutting just one recurring expense. By structuring your money so it's literally hard to reach, you systematically move from a day-one crisis into total stability by year 1, and that opens the door to real wealth building.
All right, Section 2, build your core portfolio. Entering the market safely.
Once your foundation is totally stable, we step into the market to let your money do the heavy lifting for you. This is where we shift from just saving money to aggressively compounding it. Let's impartially compare the mechanics of passive index funds, which simply mirror the market, versus actively managed mutual funds, which charge higher fees for professional stock picking. Now, as your advisor, I really want you to notice those fees. Paying up to 1.5% for a mutual fund manager often doesn't guarantee they're going to beat a simple, passive index fund that charges virtually nothing. It's wild, right?
We also need to look at exchange-traded funds, or ETFs, which offer the flexibility of intraday stock trading for general investors. Contrast that against hedge funds, which leverage high-risk aggressive strategies strictly for accredited high-net-worth individuals. For your core portfolio, the sheer accessibility, the incredibly low cost, and the flexibility of ETFs make them a truly phenomenal tool.
As your advisor, I strongly recommend a core portfolio allocation of 90% in broad market funds, leaving a strict maximum of 10% for sector-specific ETFs. Listen to me on this, never go all in on an exciting sector like AI. Keep 90% in safe, diversified broad market index funds, like VOO for instance, which tracks the S&P 500, and use that remaining 10% to strategically target those high-growth areas. That way you're not risking your entire financial future on a single bet.
Moving on to Section 3. Target income and growth, capturing yield and upside. To align your investments with what you actually need your money to accomplish right now, let's talk about massive growth. If you want to capture the upside of AI without just outright gambling, you've got to stick to the pick-and-shovel providers in layers 1 and 2. Avoid the dangerous dot-com-style bubble of layer 4. Companies like Microsoft and NVIDIA, they already have massive, highly profitable businesses. Pure startups in layer 4? Well, they've got buzzwords, but no real revenue, making them an incredibly dangerous bet for your capital.
Now notice the stark contrast between waiting decades for paper growth versus investing for immediate, meaningful monthly income. Growth investing requires immense patience, for sure. But if you're at a stage in life where you actually need your portfolio to pay your living expenses today, pivoting to income-focused funds yielding 7 to 11%, that fundamentally changes the game.
For my income clients, we utilize closed-end funds, or CEFs. These have historically paid consistent monthly dividends straight through major market crashes, and they can even allow you to reinvest your dividends below the market price. This structure is built specifically to prioritize stable monthly cash flow. And taking advantage of DR, the Dividend Reinvestment Plan, discounts quietly accelerates your wealth month after month.
Okay, Section 4. Protect your capital.
building the financial moat.
Making money is literally only half the battle. Now we shift to defense to ensure you don't lose your hard-earned capital to statistical traps, separating the absolute professionals from the gamblers. It is a well-known statistic that almost all day traders fail. I mean, 99%. And I want to explain exactly why this happens in the market. It's not just bad luck. It's a massive structural disadvantage that retail investors face when they try to play a short-term game against billion-dollar institutions.
The missing piece here is liquidity. Billion-dollar institutions literally hunt retail stop losses, your automated safety nets, to fill their massive orders. This makes day trading a highly rigged game of chance. They have the capital to artificially push the price right past your safety net, completely forcing you to sell your shares directly to them at a discount. Seriously, do not play this game.
For advanced capital protection and private deals, we require special purpose vehicles, or SPVs. These legally isolate your specific investment from the broader company's risks. If you're stepping into private equity or real estate syndications, this is exactly the kind of corporate structure I look for to protect your downside.
This structure provides a true financial moat. It ensures that your downside is strictly limited to the underlying asset, not the parent company's promises. Basically, if one project fails, it fails in total isolation. Your capital and other projects remains completely insulated. Now that is what professional risk management actually looks like.
Finally, Section 5. Scale your own asset, the multiplier effect. Reaching the upper middle class and beyond requires completely unlinking your time from your money. Up until now, we've optimized your savings and your investments, but to truly scale into exponential growth, we need to create a 24/7 digital asset, like a YouTube channel, for example, which acts as a massive multiplier for your wealth. You simply cannot trade your hours for dollars forever. You need to build a business, a real estate portfolio, or a media platform that generates thousands of dollars a month completely passively.
Here are my explicit implementation tips for your digital asset. You want to pair an SEO-rich title with a high-contrast, uncluttered thumbnail to capture maximum eyeballs. Honestly, the absolute best content in the world will fail if the packaging doesn't get the click. Focus on one main keyword, show a clear human expression, and keep it incredibly simple.
Testing data proves that thumbnails focusing on a direct, obvious benefit vastly outperform vague text that forces the viewer to think. Something like, "get more sales," gives the viewer an immediate, selfish reason to click, which results in a 25% higher click-through rate. In the digital economy, clarity absolutely always beats cleverness.
To conclude our consultation today, I challenge you to take that very first step to secure your foundation and start building your financial future right now. What single non-essential item can you sell today to hit that $500 mark? The blueprint is entirely in your hands, but remember, knowledge without execution is really just entertainment. Your generational wealth starts with your next move. Thanks for joining me on this explainer, and I'll chat you